By the late 1970s, the Soviet Union was already facing slowing productivity growth, declining returns on investment, worsening industrial efficiency, and rising structural costs across its economy. Growth rates that had once impressed economies during the 1950s and 1960s had fallen sharply. Industrial output still increased on paper, but every additional percentage point of growth required disproportionately larger spending. Then came Afghanistan. What followed was not simply an expensive foreign commitment. It became a decade-long drain on cash flow, industrial capacity, logistics networks, fuel consumption, labor productivity, and state finances. By the end of the 1980s, Moscow faced falling energy revenues, rising debt obligations, and hidden inflation. Afghanistan did not create these problems. It accelerated them. The financial lesson remains relevant today. Even large economies can go bankrupt slowly when governments mistake spending for investment and cost for value creation. Estimating the total financial cost remains difficult because Soviet accounting practices concealed expenses across multiple ministries and state institutions. Modern estimates generally place direct Soviet spending between 40 and 50 billion rubles during the intervention. Converted into contemporary dollars, estimates usually range between $50 and $61 billion. For comparison, this represented approximately 2% of Soviet annual national income and perhaps 15% of annual state defense spending. These numbers matter. Modern governments routinely survive expensive overseas commitments because their economies generate high productivity growth and possess deep financial markets capable of absorbing borrowing. The Soviet Union lacked both advantages. It possessed no genuine bond market. It lacked private capital investment, foreign investors, and reserve currency status. The Soviet government effectively financed spending through resource transfer inside the planned economy. That made the burden less visible but no less real. Costs simply appeared elsewhere in the form of shortages, delayed investment, and lower consumer output. The bill always arrives. The only question is where. Modern governments usually finance large expenditures through three tools: taxation, borrowing, and monetary expansion. The Soviet Union operated differently. Taxation existed but did not function like taxation in market economies. Borrowing was limited because the Soviet state lacked developed domestic capital markets. Factories producing consumer goods suddenly found their investment budgets redirected elsewhere. Industrial machinery orders were postponed. Infrastructure projects disappeared from investment plans. Housing construction slowed. The Soviet government effectively financed Afghanistan by reducing future investment and current consumption. Every ruble spent maintaining overseas commitments became a ruble not invested in productivity improvements at home. Many people assume centrally planned economies cannot experience inflation. They can. They simply experience it differently. Official Soviet prices remained relatively stable because the government controlled them administratively. The result was hidden inflation. Economists call this suppressed inflation. Instead of rising prices, consumers experienced shortages. Instead of paying more money for products, citizens waited longer for them. The imbalance worsened during the 1980s. As investment shifted toward state priorities, consumer industries received fewer inputs and less capital investment. Output stagnated. Demand remained. The result was monetary overhang. The largest financial burden was not salaries or equipment procurement. It was logistics. Afghanistan imposed extraordinary transportation costs. Everything required movement over enormous distances. Fuel, food, industrial products, replacement components, medical supplies, and vehicle parts. The Soviet logistics system relied heavily on rail transport. Afghanistan possessed limited rail infrastructure. This meant enormous dependence on truck transportation across mountainous terrain and difficult weather conditions. Transportation economics became brutal. Fuel consumption soared. Maintenance costs exploded. Supply chains stretched across thousands of kilometers. Logistics became a compounding financial burden. For much of the 1970s, high oil prices protected Soviet finances. Energy exports became Moscow's cash machine. Oil and gas exports generated hard currency earnings that financed grain imports, technology purchases, and industrial equipment acquisition from abroad. The Soviet Union became increasingly dependent on hydrocarbon revenue. This created concentration risk. When oil prices collapsed during the mid-1980s, Soviet export earnings collapsed with them. Oil prices fell from over $30 per barrel toward $12. Export revenue plunged. Hard currency reserves shrank. Debt servicing became harder. The timing could not have been worse. Afghanistan continued consuming resources while exports income deteriorated. This created a classic cash flow crisis. Expenses remained fixed, but revenue collapsed. Every business owner understands what happens next. The Soviet industrial machine remained enormous throughout the 1980s. Factories continued producing large quantities of industrial goods. The issue was composition rather than scale. Output increasingly favored sectors that generated little economic return. Consumer goods industries lagged behind. Technology sector lagged behind. Computing lagged behind. The Soviet Union could still produce immense quantities of steel and machinery. Global competitiveness increasingly depended on semiconductors, software, and automation. The Soviet industrial portfolio became dangerously outdated. Afghanistan reinforced these trends. Industrial planners prioritized immediate requirements on long-term competitiveness. The Soviet Union historically avoided large foreign debt. By the late 1980s, this changed. External borrowing increased. Hard currency obligations expanded. Eastern European partners accumulated their own financial problems. The entire economic bloc experienced liquidity pressure. The Soviet Union found itself facing the same problem as heavily indebted corporations. Cash flow deteriorated faster than liabilities could be reduced. The true cost of Afghanistan was not $61 billion. The true cost was everything that $61 billion could have become. Imagine investing that money in computing infrastructure, modernizing industrial equipment, expanding consumer manufacturing. Missed investment opportunities compound in the opposite direction. Many analysts debate whether Afghanistan caused the Soviet collapse. The answer is no, but this question misses the point. The single expense rarely bankrupts a large institution. Afghanistan acted as a financial stress test. The Soviet system failed that test. The economy lacked flexibility. The budget lacked resilience. The investment model lacked efficiency. The lesson is surprisingly contemporary. Governments, corporations, and investors all face the same fundamental constraints. Capital allocation matters. Cash flow matters. Return on investment matters. Large institutions often assume scale provides safety. History repeatedly demonstrates otherwise. The Soviet Union controlled 1/6 of the Earth's land surface. It possessed immense natural resources. It controlled vast industrial capacity. It employed millions of workers. None of these advantages protected it from poor economics. Afghanistan was not the original disease. It was the accelerant. The final Soviet lesson was brutally simple. Economic strength is measured by how much productive capacity remains after the spending stops. The Soviet Union spent approximately $61 billion. The financial return was effectively zero. The opportunity cost was an empire. I hope you enjoyed this episode. To make sure you don't miss my future work, subscribe to my channel and press the bell notification button. Thank you for watching and see you in the next video.